There's a lot of risk and uncertainty in the market. It's a very challenging place. Running this engine in the background in your portfolio is just a way to completely dominate things like the S&P 500. There's all this controversy around Warren Buffett when he said that he could guarantee that he could make 50% returns if he was only managing $1 million. And everyone kind of wants to know how. And the amazing way is there's a lot of ways that he would do it. If your viewers implement this, I'm sure they're going to make a lot of money.
Hey, Believe Nation. In today's interview, I sit down with Matthew Peterson, a value investor. He runs Matthew Peterson Capital, and since inception 10.5 years ago, he's delivered $1 million would turn into now $5.2 million, which is 17% annualized rate of return per year, outperforming the S&P 500 index fund. So we go over everything from how to build wealth, investing, and a very specific strategy that he uses to really compound capital and outperform the market. So with that being said, please sit back, relax, and enjoy the interview. Welcome to the channel, Matthew. Very excited to talk to you, to give the audience some background and for you as well. Basically, I interviewed Phil Town. And on the question, we talked a lot about, investing and building wealth. And one of the questions I had for him was, hey, as I'm stockpiling cash for my business and other people are having cash in their bank accounts, inflation rising, and, what do we do to, finding investment opportunities is really hard right now. What do we do? And he actually brought you up in the interview talking about a strategy around options trading and how you could actually be the house and not lose 90% of your or 99% of your money like most people use options trading. And this was very different. And so I'm just super excited to kind of now go to part two after talking to Phil and now about to talk to you about what is this strategy that if you're willing to really put in the work for people, and it's important everyone knows this, really put in the work on how this could actually be a wealth building opportunity for those who are interested like myself and the viewers. So I'd love to know, starting off for options, what are they? Calls and put options for the viewers to understand, and then we'll move into, as the interview progresses, more complex things. But starting off right there.
Thank you, Jeremy. That's a great introduction. It's nice to see you again. It's nice to be with you. The last time we were together, we were dining in Switzerland. So yes. I'm glad we were able to make this all work. I'm happy to jump into I'll talk, I think, really quickly about the simplest forms of these contracts. And then, as you mentioned, we'll go into some of the complexities. There's such a unique situation going on right now. So I'm very happy to share this with you. It's really the first time that we've gone public and talked about this. And if your viewers implement this, I'm sure they're going to make a lot of money. So why don't we talk about the basics? You asked about calls and puts. And so basically a call is a option contract that gives you the right to purchase stock at a specific price at a specific date in the future. So you buy this contract and it's tradable on the exchange. You can buy it through the Chicago Board of Exchange. And you're basically, you choose any underlying equity, like just whatever you'd like to choose. You can call it Apple. And instead of buying Apple the stock, you want to buy a call on Apple. You choose the price that you're willing to pay for Apple a certain period of time in the future. It could be 3 months, 6 months, a year. And you'll pay a little premium for the right to buy Apple at that price in the future. And then the outcome is it's either in the money or out of the money. So if the price of the stock is above the price that you're willing to pay, you still have the right to buy it for that price. That's what you bought. You bought the right to pay a certain price. And if the stock price is below the price, the contract expires. You wouldn't pay more than you could buy it for in the stock market. And so it just expires and you can go about buying the stock a different way. A put is exactly the opposite. So if we took a generic example and said ABC shares are selling for 100, the traditional use of put, which is not how we're using them, but the traditional use of the put is to protect your portfolio. So if you hold ABC stock and it's selling for 100 and you think something about the shares and you're worried they might decline, you could purchase some protection. So maybe you'd purchase the right to sell the stock to somebody at a certain price at a certain date in the future. So you might say, well, I'm happy to take a little volatility, but if it falls below 90, I'd like to sell. And so you would pay a premium for that right to sell it. And so maybe you'd pay, let's say $5. So you're going to go out 6 months and you're going to say, I'll pay $5 now. And if it falls below 90, I still get to sell it for 90. So if it drops from 100 to 50, you still have the right to sell it for 90. And so that's how a put protects you. And most people think of calls and puts as terms of buying them. So you can buy a call and it gives you the right to buy the stock, or you can buy a put and it gives you the right to sell the stock. Does that all make sense? It's pretty basic, fundamental option information. The way that we're going to get into here is all inverted, and but it's really simple. So instead of using a call to buy the stock because you buy the call, we use the put to buy the stock because we sell the put. So the put buyer allows you to basically sell the put or put the put to someone else at a certain date in the future if the price falls. If I sell the put, what it does is it gives somebody else, it's underwriting the option contract, it's underwriting the underlying equity. So it gives somebody else the right to put their shares to us. So in a hypothetical ABC stock equity situation trading at 100, the way we think about things, and very advantageous way of thinking about things, is that we approach this from a value investing perspective. We're looking to buy shares when they go decline in price. We're not looking to sell shares when they decline in price. And so if we know about something about the underlying business, if we know something about the management team, the quality of the management team, and we know that it's a very fair price for this business, and the shares decline, it actually entices us to buy more. And so in a situation where we want to be buying the shares, instead of buying them in the New York Stock Exchange for $100 a share, let's say that's what they're trading at today, we would instead sell a put contract committing to buying for $90 a share, and somebody would pay us $5 for the right to sell us the shares if they decline to 90. And then further, if they decline to 90 or beyond, our net cash outflow then becomes only $85 because $5 was paid. So we're literally lowering our cost basis to a price below the stock market price. So we are not paying retail prices for the stock.
This is like a heads I win, tails I win, right? So it's like either you get it, what you wanted, or if you don't, you do get a bit of extra cash flow coming off of that.
That's exactly right. So if you want to think about it like this, there are essentially 4 major buckets. This is a common question that people ask. So let's say we started in options 101. Now we're in options 201. Okay. So in options 201, people always ask, well, what are the potential outcomes? Okay. So you write a put on a stock that you want to own. There's sort of 4 fundamental buckets that could occur. And the mindset, so keep in mind, everything needs to come from a value investing perspective. I run a long-term value-based fund, right? Everything is coming at this from a value lens. So this is how to use options with a value bent to it. So there's 4 basic underlying buckets. Always think about this as owning the notional equity value. So if you've committed to buying 100 shares for $90, basically a share, you're basically committing $9,000 toward this transaction in terms of a notional. So what happens is once you own the shares, a few things could happen, and not once you own the shares, but when you've written this contract. One, you could be totally wrong in your analysis. Okay, it would be a terrible. The worst situation is the shares actually go from 100 to 0. All right. So instead of losing 100 where you had bought the equity, you now lose 85 because you bought for 90 and you were paid 5. So you actually decrease your absolute loss, you lower your risk. It's a risk reduction mechanism, but it's still a terrible outcome. Obviously, the shares just decline to 0. All right. That's one scenario. The other scenario, the most attractive scenario, is that the shares go from 100 and they decline to just below 90. They're put into our portfolio. They only cost us $85 a share. And now instead of buying for 100, we got paid to wait. We own the shares, and as the stock appreciates, we have a lower cost basis, and we literally have a higher IRR. Our annualized return is greater, and so that's scenario 2. Scenario 3 is the shares don't decline below 90, and we keep the $5 on our $85 in collateral. And I basically chose these sort of silly numbers, but it basically becomes a 5.8, almost 6% return. I said a 6-month contract, I believe. So we're talking about 6% over the course of 6 months, which is just fine. You can actually get quite significantly higher returns. This is a really basic scenario. That's the third outcome. So the contract would then conclude, and you would keep the premium. So you'd make your very reasonable IRR. The fourth scenario is you are correcting your analysis and the shares go straight from 100 to 300. You do, in that case, miss the upside. That's an unfortunate situation, but nobody seems to complain. Typically, you can earn a lot more, like 10, 20, or 20% plus IRRs with these premiums. So you're basically capturing a 20-something plus IRR on the premium, but you've missed a 200% gain. So I used a really small number. I just said a $5 premium on a 90 stock. That's probably not sufficient, but you may be able to do it. You may be able to get significantly more. You might get $10 or even $15 on a $90 strike price.
In order to not miss that 200% upside, do you allocate? So you do have a portion going into this company and you'd love to buy, you want to get that strike price. Do you go in at a position where, let's say it goes to $90 or it falls to $90, you get put the stock, and then it falls to say like $78 or $80. So another $10 comes off. Do you then do another options bet, or do you actually just decide to put in a second tranche of just capital into it without doing an options call that time?
Great question. So, and this is, we're still kind of in the 201 phase. Maybe we're getting into the 301. It's very different if you're managing a fund like ours, or if you have a very sizable, personal account, versus maybe a typical retail investor with 100 or maybe up to $1 million. So you would approach these in different ways. But what you're basically asking is, would you cost average or not? So you would have to evaluate your total notional exposure. You'd have to look at the percent allocation that you want within your portfolio. And if you have sufficient capacity to buy more, you do your analysis and you consider potentially selling another put. And that's exactly right. So you can cost average if things do decline further. And certainly it's something that we do. And yeah, you'll of course get paid another premium and it potentially higher IRR. So that's a very good question. It's nuanced for every individual portfolio. So it would have to be considered on a portfolio by portfolio level. But what I want to get into here, I want to kind of set this baseline at 201 where people understand we're inverting the use of these calls and puts in a very unique way. Most people have trouble, if they've learned it the wrong way first, they have trouble shifting their mindset to this. But we're basically looking to use these contracts not as speculative products in any way. We're not looking to trade these products in any way. We are literally using them as a tool to purchase the underlying equity. So instead of buying a call to get that stock, which is our cash going out, we sell a put to get that stock. So somebody else pays us and then gives us their shares. And so we get to buy the shares for less than they would cost in the New York Stock Exchange, less than they would cost to any retail investor. We're doing what I call structured value. So we're basically looking for ways to just lowering our purchase price, increasing our margin of safety, and getting access to these shares. So this is the fundamental baseline that all the viewers need to know before I get into this really unique situation that is happening right now, and people can make a fortune, and it's individual investors can apply this. I really encourage people that understand it to put it to work because it's quite lucrative at the moment.
Yeah, and it's I'm very fascinated for you to dive into 3.0 and then 4.0. Already listening to this because I was shocked to hear that Warren Buffett is also a huge options. It's big
absolutely.
in options as well.
So at this baseline level that we're discussing, Warren has had a history of going in and buying entire companies using short put contracts. So people think oftentimes because they learned in B school or something that, options are risky and they're, for speculation. But if you use them properly, they can be really advantageous. So Buffett was selling puts on Coca-Cola when he bought 10% of Coca-Cola. He also was selling puts on Burlington Northern Railroad when he bought the entire firm back in, I think, 2007. And it's quite remarkable if you think about what Buffett is able to accomplish. So he goes out and he sells puts and gets paid premium on, I don't know how many millions and millions and millions of these contracts he was able to write, but he's out there writing these contracts, collecting premium, and then he puts in a bid for the whole company above the strike price of all of these contracts. So he just gets paid, and then it, of course, never goes down. So he just got all this free money, and it really lowers his cost basis. So when it's available, and this isn't always available, but when the situation is available, even Buffett at this level with, allocating billions and tens of billions in a single time will attempt to use this strategy. So this is, it's fairly sophisticated. It's pretty advanced, but I know quite a few professional and retail investors that are using this in a certain way.
That's amazing.
Okay, so and I'll actually elaborate that out with one more point just to really drive it home. I figured this out in about 2005. I was working on Wall Street doing consulting for Goldman, doing risk management work, and I was dealing with all these different products within the firm, writing all these sort of helping them with model validation things, and recognize that instead of buying the stock directly, you could write these puts and just combine it. It's little algebra, and you basically end up with a lower purchase price. And over the last 17 years, this is the only way I would buy securities. It seems unfathomable to me to just buy a stock in the New York Stock Exchange because I can just turn around and I just sell a put and it could expire in a week and I still get a lower price. So so I always use this, and when it's possible, whenever it's possible, I use this. I can't fathom doing it the older traditional way. And so I encourage, the folks that can understand this to try it. Keep in mind an option is 100 shares of stock. So, don't go and overexpose yourself. But this is a very advantageous, and you learn a lot just by doing it once or twice and watching how it all plays out. Now, I think we're ready to move into a more complex application of this, something that we figured out over the last couple of years and have made enormous returns with. What I'm going to talk to you about is something that we call internally structured dividend capture. It's a super awkward name, but that is exactly what we're doing. Is we're literally ripping dividends out of the market. It is not the traditional use that I was just talking about. We're not high frequency traders, but it's a lot more transactions than we're traditionally used to. But it's so lucrative right now that, especially in this challenging market where we're dealing with inflations and we're, still on tail ends of pandemics and we have, wars taking place, there's a lot of risk and uncertainty in the market. It's a very challenging place. Running this engine in the background in your portfolio is just a way to completely dominate things like the S&P 500. Let me quickly share with you what are we going to be talking about? What is structured dividend capture? So basically, there are, so these contracts are priced based on the Black-Scholes model, and there's 5 Greeks. One of the main Greek that we're kind of thinking about right now is volatility. And we're in a period where there's a lot of, and it's always local vol with various companies. So we're in a period where there's a lot of volatility kind of showing up, and there's actually a volatility to volatility. So markets might not be volatile tomorrow, but next week, they're extremely volatile. And so those are what's changing option prices in a major way. There's other factors like time and things. Why don't I go ahead and start kind of sharing a screen here? Because what I'd like to do is walk you through how this came to be. I think this background is going to help your viewers understand. I'll go very quickly here. How did we come across this? All right. So we have a 4-step process for our own portfolio management. And it starts with, I've talked about this a lot in the past, so if people want to go into any other videos, they can go and look at detail. But it starts with this quarterly 13F analysis. So we're looking at, say, 100 super investor 13Fs. We're looking at all the shares that they're buying and selling. It's a big advantage, and it basically narrows down the world of investing from like 10,000 potential securities to a few hundred potential securities. Okay, so if you look at long-term value-based concentrated funds, they may have billions of dollars, but they have 7 holdings. And it becomes very interesting to see people like Bill Ackman buying and selling something, or David Einhorn or Guy Spear buying and selling something. And it's interesting. And when they're putting this huge allocation into a new opportunity, they've spent hundreds of hours, thousands of hours, maybe millions of dollars researching the opportunity, and their own conviction has allowed them to put a huge percent of their portfolio into that. So it's a really interesting thing to go and look at. So that's where we start, and we narrow down the world of investing to a few hundred securities. We then go into our fundamental analysis, which is determine what the intrinsic value is of these companies. And if we can understand why there's a big discount, why it might close, why there's great opportunity, it becomes very attractive. The next step is to apply structured value, which I just explained. So that's applying the option strategies, figuring out how we're going to buy. And I'll of course mention, when we sell a security, hopefully we don't have to sell for a very long time because that means it's just compounding and compounding. But when we do sell, we would use a covered call, which would be a short call, a sale of a call to exit. So we get paid a premium to leave, just the same way we use a short put to enter. And then position sizing is our final step. So this becomes pretty important, because what happened in March 2020 is I was doing our 13F, continuing with our 13F analysis. And as the 13Fs were being filed, I noticed that the total superset of companies had nearly doubled, which meant that all of these investors we follow were diversifying in a major way. And I also noticed that a lot of their purchases, and this is just helpful information as you're managing your own portfolio, but I noticed a lot of their purchases were going into really high dividend paying stocks. So suddenly folks were more interested in an AT&T that pays 8% dividends than maybe Amazon or Google. And whether they're right or wrong is irrelevant, but the amount of high dividend payer securities that moved into the 13F bucket was remarkable. This is an old strategy, but it made me realize that because the price had fallen and some of the dividends, payers were maintaining their payout ratios, the yields were really high. And in the past, people have tried to buy a stock right before, you get this. Dividends are different than bond yields. Like bond yields accrue, but a stock, if you hold it on the ex-dividend date and across the date of record, which is usually the next day, you could sell the stock after that and you get the dividend payout maybe a month later. So you just need to really hold the shares across a couple of days. So this isn't new information. There's been a lot of research out there and people out there who have tried to buy before a big dividend and then they sell after the dividend. And efficient market hypothesis would kind of say that the price would decline a little bit. It doesn't always quite work that way. It's an okay strategy. It's fine. One thing that's interesting, this doesn't scale. What I'm about to tell you doesn't scale to the major players. You can't put trillions of dollars in this. I don't think you can even put, you really couldn't put $1 billion in it. We run a modest sized fund, but you can easily put 10 or 20 million through this. And you can certainly put 100,000 through this. And it always reminds me, there's all this controversy around Warren Buffett when he said that he could guarantee that he could make 50% returns if he was only managing $1 million. And everyone kind of wants to know how. And the amazing way is there's a lot of ways that he would do it. And I think that this is kind of one of the types of things that he would do. He's not necessarily going to do the traditional buy and hold route. If he has $1 million, he's going to do something pretty creative and he's going to be ripping 50% returns out of the market. I'll show you here what we're talking about. Real quick step back. This is like this is how I track our 13F analysis internally. So this is just an example. This is, old data, but this is how it works. So we pull and we look at what shares are being bought, what's being sold, what's being held. We look at the superset of all the data, and it's very helpful in just guiding our fundamental analysis, as I mentioned. And this is a really good example. Sorry to just run through this presentation, but it's helped to repeat to give everyone a refresher. How do you buy a share of stock for $100? We sell this put. So in this scenario, If anybody wants to look and read through all the details, we're basically saying we're committing to buy shares for $100 over the course of a year. Somebody's paying $25 in premium for the commitment to buy that stock. And we then hold $75 of our own cash and collateral and the $25 they paid to us, which makes the $100. So we're able to buy the shares. And then there's a binomial outcome. Either the shares are below 100 and we buy the stock and it only costs us 75 because 25 was their money, or it's above 100 and the contract expires and we've made 25 on our 75, which is a 33% return in a year. Okay, so we either get the stock for 75, which is great. So when the shares appreciate to 750, we make 10x, whereas the person who paid $100 only makes 7.5x. And alternatively, we make 33%. So the binomial outcomes are both positive in the event that the shares don't go to zero, or like the first scenario I described. So here's an example once again about how they'll put. Now, let me jump into this. We're going to go quickly now into like the 4.0 level. So now everybody understands how to sell a put. Everyone understands the strategy and that we're looking at how to capture these dividends. What I realized is that if we sold a put that expired just a day before the next ex-dividend date of one of these high dividend paying stocks, we would collect a premium for the put, then hopefully we put the shares. And if not, it's okay. We still make a good IRR, but then hopefully put the shares and then immediately receive a dividend. And then we sell a covered call immediately afterward and get paid another premium and we exit. And so we actually get 3 payments instead of just the dividend. So we make a put premium, so our costs go down, then we get paid the dividend, and then we sell the call and we pay a call premium and we exit. So what does this look like? I looked around at some of the high dividend paying stocks, and here's one for KKR. Now you'll have to bear with me because the prices are all changing, and some of this data is from 2021. But you just go and you look up the current prices and you apply it to today's current market prices. You're only holding these shares for maybe a few weeks maximum. So what happens here? This is for KKR. All right. So, and this is a relatively small dividend, to be honest. So what you can do here, and we're just using these this is not a generic example, so I'll just go through the dates without the year. You sell a put expiring November 5th with a strike price of $80 for $2.65. Okay, so you're paid $2.65. Now, just a few days later, November 11th, you take possession of the stock. The next day, you receive a small, in this case, 0.2% dividend. You then turn around and immediately sell the call, and then the call expires. And here's what it looks like. You pick up 3% on the put, you pick up 0.2% for the dividend, and you pick up 3% on the call. And in total, by the way, there's a few little rounding things here. Over 12 days, you pick up 6.8%, which is an annualized 650% gain. Okay, so 600, it's so astronomical. But the problem, of course, is that dividends are traditionally paid 4 times a year, so you can only do this 4 times a year. All right. So, but it's something to keep in mind. So if you're looking, Jeremy, and you have your favorite, equity position out there, and they pay a large dividend, you can do it. You could just do it ad hoc, with right before the ex-dividend date. You could practice this, and you could watch it all play out over the course of a couple of weeks, and make a very, very decent return.
And this is so. Just to be clear, this is looking at companies that you do firmly believe in. This is not just going off.
It's a little different. Yes, that is correct, Jeremy. I don't mean to interrupt you, but how do we treat this in our portfolio? We have a basket of these going on, and we have about 20% of the portfolio allocated to this particular strategy. But this is very different than the more traditional approach. So we run, for anybody who doesn't know me well, Jeremy, I'll just say that we run a long-term value-based portfolio, Peterson Capital Management. We've been doing it for over 10 years, and we are fundamentally using this structured value strategy to enter into positions. But ultimately, we own these businesses. We own a few percent of various firms, and we truly think of ourselves as owners, and we hold them for the long term. Our longest holdings over 10 years. So we are not traders. We are not speculators. I put a lot of work out on Daily Journal, and a few other companies that some people may be familiar with. So this is a more advanced, much more transactional in nature strategy, but it works very well right now with heightened volatility on high dividend paying stocks, especially in this time of all this great uncertainty. So to that point, traditionally and typically, we are buying and holding companies with huge conviction where we understand basically we're looking for the greatest business models in the world. Okay, so this is like in today's world, this is like a SaaS business, has just an outstanding business model. Then we look for the greatest management teams in the world. Okay, so we want basically a company that's going to have huge cash flows, and then we want a management team that's going to be able to handle those huge cash flows properly, because the management team gets to destroy or create value depending on what they do. They could buy back shares at the right time or the wrong time, or they could pay a dividend at the right or wrong time. They could issue stock or issue debt at the right or wrong time. So you need management in place that's highly competent, like top management teams in the world. And then we're looking to pay a very fair value. So traditionally, we're looking for great business models, growing businesses, but deep value growth businesses like the Phil Fisher kind of growth, and great management teams. That's what we want to hold on to. Those are going to compound. In this scenario, what we're looking for is a company that is going to be pretty reasonably stable, has a reasonably stable business model over the next few weeks. We don't want something that's going to sort of blow up or there's going to be some big drawdown. But as long as these are more, in fact, a lot of them end up being kind of blue chip companies. So as you'll see, we end up with like AT&Ts and Chevrons and Exxon Mobils and things in this bucket. So these are just stable whales that for some reason are paying a statistically significant higher dividend and also have volatility a bit in their price, which means these premiums are high. So that's really what we're looking for in this scenario. It's a bit of a separation from some of the traditional stuff that I've talked about, which is why I told you this is kind of a unique strategy, especially in the value space. Okay, so it's going to take some open-minded value investors to get all the way to this level. I'll share one more quick example. Basically, I mentioned you can do KKR 4 times a year. And it's actually not the best example because it's such a small dividend, but Lumen Technologies, they pay an 8% dividend per year, which is 2% quarterly. That sort of becomes meaningful. So in this scenario, what you have to look at is what's the put expiration date right before the ex-dividend date. Okay, so go find the ex-dividend of your favorite security with a big dividend and find the put right before it and sell that put pretty much at the money. You want to get put the stock and you want it to be a high enough dividends or a high enough premium. You're going to have to calculate the IRR on the premium against the collateral you need to hold. In this scenario, we're just using these dates. Your put expires November 19th, okay, with a $12 strike and you get 58 cents. These sound like small numbers, but because the time frame is short, it adds up. So you're going to get 58 cents on basically $11.42 in collateral, okay, because that would add to your $12 strike. And then that expires November 19th, which is right before. So then you take possession of the stock in the event that it gets put to you. And if it doesn't, you still win because you keep the premium and you're just done. But if it gets put to you, the next day, you get a 25-cent dividend on November 25th. Not the next day, but 6 days later. Okay, so the ex-dividend date is November 25th. And then immediately after that, you can sell a call, and that call can expire November 26th. And we've actually changed, this is just an example here where we've used a different strike price. We've said, let's sell a call with $11.50 strike price. So we're definitely going to exit this. And we pick up a 90-cent premium. So we've picked up 58 cents going in, 25 cents on the dividend, and 9 cents exiting. And we basically end up with a 10.8% return on our collateral over 26 days. All right. So keep in mind, and Jeremy, you're a little younger than I am. So you've been experiencing this massive bull run for most of your life. But if you look through centuries of data and you look at even decades of data, the really consistent annualized return of the markets is 6.8% per year after inflation. And it's very difficult for professionals to beat that. what I'm showing you here is how to make 10% in 26 days. You could literally pack up your office if this works for you once and go for the year and probably beat a lot of people, but you can do this 4 times. So what happened next is I started thinking, well, what if we could just run capital through a whole bunch of these? It's hard when there's only 4, but if you can line up a whole lot of these and their ex-dividend dates are different, then you can just move capital through from one to the next. And here's another example on McKesson, by the way. This shows just a 7.5% return over 33 days. But here's what ultimately you want to get to. So these examples feed right into this. This is just, in fact, this will probably be valid with different prices this October, November, December. So you basically, this is an example where we start with $1 million in October. We start with KKR, we sell a put, we get the stock, we get the dividend, we sell a call, we exit. Now we move to Chevron, we sell a put, we get the stock, we get the dividend, we sell a call, we exit. We move to Lumen, McKesson, Occidental, NetEase, and Seagate. And not all of them will work perfectly, but the returns are so astronomical that you can afford to have a bunch of them completely fail and you're still going to make a huge return. This flow diagram shows $1 million turning into 1.8 million in 3 months. It's an 84% return in 3 months' time. It's incredible. It is so lucrative the way you're getting paid 3 times over a very brief period of time that in our parameters, we actually don't engage in any security that has less than 100% IRR. So if it isn't going to return over 100% per year, we just throw it away. It's just not worth it for us. There's other opportunities. There's so many opportunities like this that are paying this amount. And it's because of the extreme volatility. Some prices are down. If they're maintaining their dividends, when the price is down, the dividend yield is up. So you're getting vol, low price, and a good dividend yield, and it's turning into this type of opportunity. Now, I'll share also this with you. Actually, I'll go in 2 directions. First, I'm going to point something out that everybody will want to know. This seems too good to be true, and it looks like it's not arbitrage, but it's sort of something in the realm of, there's an anomaly in the market. How could this possibly exist? Because if this existed, it would be gone. It's like the old tale where the professor says there's no $10 bill on the floor because if there was, somebody would have already picked it up. So why hasn't this been picked up? The reason is these option contracts don't have sufficient volume to accept billions in capital flows, which means none of the smart money is in this space. Goldman Sachs is not playing this game. And even if they understood this completely, it would not be worth their effort. They would have to hire people, hire a desk. They'd have to feed it into all of their systems. They're never going to participate in this because they might max out running, say, 50 or 100 million through it. And even if they're making $50 million, that means it's meaningless. Okay, JP Morgan doesn't care about this opportunity. Furthermore, this is sufficiently complex that most retail investors would have no chance of doing this successfully. They wouldn't even think to consider this opportunity. But if you're told it in a simple way and it's laid out to you, I do believe you can implement it. You look at your high-paying favorite dividend stocks that have option contracts and you just write a put that expires before the dividend date. And this is what is going to happen for you. So what's happened is basically retail investors, unfortunately, are not sophisticated enough to implement this. And smart investors have too much money to participate in this space. And so it leaves it wide open for those of us with, say, between $1 million and $100 million to manage. And so we can just push capital through this and make an absolute fortune. There's one more challenge, which makes it even more interesting. And that is that the analysis itself takes an enormous amount of effort, and most people aren't willing to do it. And then the prices are always changing. The options are complex. And so each quarter, each month, and each quarter, you need to redo a very time-intensive analysis. And so when we first started looking at this at our firm, it was during the 2020 year pandemic. And I started implementing it in a test account that I run, a real money test account, a PA. And I started recognizing how lucrative it was and how time intensive it was. And I usually test things there before putting things into the portfolio. So I realized that this was a massive opportunity. We were just making such an extraordinary return with a small amount of capital, with about 150,000. We were just sort of doubling it. It was very easy to do.
In terms of time and intensiveness, like, of course, there's no number you could say, but for you personally, like, how many hours per week do you think that took to really see this be effective and lucrative?
I've already done the hard work for you, Jeremy, and all your viewers. This is the answer. But so what would it be? It's sort of like I was just thinking about it for an hour a day for a while. And then when you actually sit down and start doing the analysis, you start spending complete afternoons a couple times a week. So maybe you're spending 4 hours on something. So maybe it's 8 hours a week it took a while. It took about 8-10 weeks. And you're also trading and implementing and testing it, right? I'm not certain that it's going to work properly. I'm not confident to put it in the portfolio. So I had to test this. I had to recognize, I had to look up all sorts of nuances. Okay, there's some tax ramifications, Jeremy, that we can touch on. Maybe I'll just mention now that unfortunately, instead of having long-term capital gains that I'm very accustomed to, or even just totally deferred capital gains because I'm holding on to a business that's just compounding and not realizing any gains, this is all taxed at your personal income rate, including the dividend, because you didn't even hold it to get preferential dividend treatment. But the gains are so high that it's worth paying the taxes. It's like if there's $20 sitting on the floor, and if you pick it up, you have to pay 35% to the government, you're still going to pick up the $20 laying there. And that's exactly what we're doing. It's such an obvious, incredible situation, but the time intensiveness is challenging. So you can do it in a less sophisticated manner. Maybe you just have 5 dividend stocks, and that wouldn't be that time intensive. You might grab a few of these. You might have your own favorite companies. There's a few oil companies and AT&T, even Icon Enterprises always seems like a fairly good one. You can just get a good premium, and then they pay an 8% annual dividend, so you get a 2% dividend, and then you get out with a call. And I'll add something to this, and this is where you do need. This is why it's 4.0 instead of being or 401. This is like we're to the 401 level. It's because you really need to understand how transacting in options work so that you don't get caught off guard. So if you sell a put and the put expires out of the money, that's fine. You just would move to KKR to Chevron. That's not an issue. You don't make a full 7% that week. You might make 2% that week, but that's okay. You just made 2% in a week. If you get put the shares and then you sell a call and the shares decline and you don't exit, that's also okay. You just need to sell another call the next week. And depending how you've rolled your capital together, we're actually using a basket. So I've simplified this a lot to show one particular cash flow stream, but it's not really how it looks. How it really looks is KKR would be balanced with another 10 securities that are all expiring at the same day. So we're actually every week we're rolling a basket. And so if a few of them decline in price and the calls, we don't get called away, we still own the shares. That's actually not that big of a deal at all. We can actually make more money by just selling a call that expires the next week and then selling call that expires the next week. And every single week, we're just picking up another 1 or 2%. And as long as the call premium is outweighing the decline in stock price, we're still at a net positive. And even if we actually expect sort of over the long term a normal distribution. So we expect some to work very well, most to be somewhere in the middle, and a few in our basket to not work well. So there's always going to be a couple that fall in price. And then we sell calls, and we exit. And so we need to have sufficient gains in the other positions to offset a few or a couple that might not work out well for us. So if AT&T gets cut in half, that's very unfortunate, but we'll end up in our basket with a few of those over time. We just need to make up for that. We're looking at probabilistic thinking. We're looking at, averages, and because let's say that we're in 10 positions in our basket at once. We would only have, let's say we have 15% exposure in our whole portfolio, and we have 10 positions in our basket. What that means is any particular position is just 1.5% of the portfolio. We run a very concentrated portfolio. Some of our positions are 18, 19%. Daily Journal is a big one for us around that number. For example, a 1.5% position is not a concern. And if it falls in half, we're still getting put premiums, call premiums, dividends. So we're not losing half. And right. So we're losing less than half of 1.5%. Okay, so just put it all in context. So this is a very simplified explanation. I think your viewers can take a handful of their favorite high dividend paying stock and lay them out and do it casually without a lot of time intensiveness. What we needed to do it properly was build a Python script and automate this whole thing. So basically what we've done is I hired an intern. I don't write script, but I know what we needed. And thanks to actually some presentations at ValueX with Guy Spear, I knew that it needed to be in Python, which was a huge help. So I hired a developer, and we basically built out a system that we could run. So instead of it taking weeks to figure out what that capital flow would look like with all these baskets, it just takes a couple hours. And we run this script. So we pull all the 13F data into spreadsheets, all the 100 different funds that we're analyzing, and we look at the superset. Then we go to a Capital IQ and we pull down all of the financial data into the spreadsheet. So we can look at what is, for example, what are the dividend yields? How stable are these companies at a high level? Is there really bad ratios? Like, is their debt putting the company at risk? We can throw out things that are of concern. And then how many remain? And Jeremy, when we do it this way, we might have 500 companies on the superset analysis of our 13Fs. It shrinks to about maybe 60 companies that have high dividends, that are stable firm. They don't need to be stable on price, but they need to have stability within their businesses. So it shrinks immediately to 60. And then we can go through quickly. I can go through manually and throw out companies I don't like. So there is a little overlay where we just say we're not going to get involved in that. There's, that could go wrong. And then finally, the Python script goes out and grabs all sorts of option data. So we can analyze the Greeks and we can look at what the premiums would be. And you can see on the right, this is literally the output from our script. So I'm just showing your viewers the answer here. We get a 13F superset analysis right on top. Then we get all the financial data plugged in the middle, and it just highlights and runs macros. And it's pretty, it's a little bit complex, but it can be done. We've done it, and your viewers can do it. And then finally, at the end, it actually builds out this flow diagram where it lists the companies that fit our parameters with above 100% IRRs, that have options with huge premiums, where the puts are set, puts are being sold and expiring right before the ex-dividend date, and we can get the stock, we can get the dividend, we can get the call premium, we can exit. And that's exactly what we get down on the bottom right. And it basically lays out how we're going to flow our capital for the next quarter. And we just start implementing that, and we're just seeing gains and we're doing it actually conservatively, but we're still seeing double-digit gains quarterly implementing this strategy.
Wow. Yeah.
How clear was that, Jeremy? Could you follow? I think that worked all right.
Yeah. No. Yeah, that was amazing. Seeing you break it down like that. And then so in terms of okay, so you built out this system. Here are the things that, if we're really going to put in the work to do this ourselves and move through the, 1, 2 step, 3 step, and then eventually get to 4 step and take those baby steps. at that level. So step one, looking for stable companies that have a high dividend yield, and then looking at companies that, based on my own experiences and morals and etc., that I don't like, and toss those out. Then looking at the Greeks and premiums to see, does this get above 100% IRR?
Yeah.
And looking
annualized.
Annualized. And then from that, knowing that data, it's then a matter of seeing, okay, when does their ex-dividend date end? And then how do we find the closest expiration date of the options?
Congratulations, Jeremy. You got it.
All right.
That's it.
Perfect.
So as you implement this, you'll find there's a lot of unique situations that pop up. So I recommend just going slow. Start with, you don't need to do the full 13F analysis. And I'm going to also take one more tangent to what you said and point out it's a very special advantage to start looking at high quality 13Fs. Okay, you can just go to sec.gov. You can pull down 13F. For anybody who doesn't know, the 13F is just a snapshot of the portfolio holdings of a super investor. So if you go to a 13F, it helps you eliminate a whole bunch of errors. I think if you start from the standpoint of who's paying the highest dividend, you might find yourself in a bad situation where you buy a company with an unsustainable dividend, or where the shares price is really falling. So I think it's more appropriate to come at it from the lens of what's the greatest business out there, and then are there any of these that have a high dividend? And one way to do that, a shortcut way, rather than just screening, because what would you really be screening for? You go look at some 13Fs and you say, okay, so this company shows up a whole lot of times. It's owned by whoever your favorite investors are, but it can be sitting there in Warren Buffett's portfolio and Charlie Munger's portfolio, and Manish Pabrai owns it as well. So you know what? Okay, it's probably pretty reasonable, and it happens to be paying an extraordinary dividend. And when you find yourself in that situation, you can use these option contracts as a smaller investor to just rip these dividends out of the market. And so I just want to point out, it's really important to start from the lens of what's great business, and then where's a high dividend, not where's a high dividend and right. Can I make this work?
And I guess even though this is your 20% capital is, say, different than your long-term strategy, extremely high conviction on each bet you make, the margin of safety does come into looking at the guru investors who, that's where the margin of safety does lie. Yeah. Well,
the margin of safety is also in just lowering your strike price and things like that, but but you're mitigating your risk in a certain manner. Look, so I always get in these challenges with the efficient market hypothesis, because if the efficient market hypothesis were true, even though it's a Nobel Prize winning hypothesis, firms like Berkshire Hathaway wouldn't exist, because there would be no way for them to consistently be growing faster than the market. It says that that's impossible. So we know that it's not totally true. But the problem is that doesn't mean that it's not true at all. It's actually mostly true. So most securities are priced accurately most of the time. And you need to be turning over so many stones to find a mispriced security. If you start from the approach of a 13F analysis, you're looking for needles in a haystack anyway. But if you look at 13Fs, I think you're finding a lot more needles than hay in that basket of securities. So I think you reduce your risk of making an error. There's a lot of conviction behind those positions that they're going to appreciate. But we see a lot of mistakes and errors happen. Okay, we see Bill Ackman buy in and sell out of Netflix and lose a bunch of money, and so you can't just blindly, everyone makes errors, and everyone has either and there's probabilistic thinking involved, and so you don't want to do this and implement it blindly. But if you have some great companies in the back of your mind that pay a good dividend, you can go in and implement this and probably do very well.
Wow. Yeah, that was amazing. Thank you so much for breaking that down. Really making sure that I understood the process. I will rewatch this and rewatch this.
Thank you.
Going through this.
I'll add just a really quick additional point. And maybe maybe this works for a retail investor with a big salary. It certainly works for a fund manager like us because we're bringing in capital almost on a monthly basis, and we need to allocate that capital. Fortunately, we have way more ideas than capital. But you asked a good question earlier, and it's like we treat this as one position, and it's about 15 to 20% of our portfolio. But when we would prefer, even though this is so lucrative, it's time consuming. There's taxes involved. And also, Jeremy, this will not always work. So you can't, this is not something that you can just implement through. Watch the VIX as like a macro indicator, even though I don't really like my macro like that. It's a micro level vol that matters. But if the VIX is high, this is probably going to be working well because you're getting high premiums for your securities. Fear is high, so puts are costly and so are calls. If the VIX is low and the world just seems to be moving along perfectly, you're not going to get sufficient premiums, and this isn't going to work anymore. And It's not, especially not going to be worth it after you pay commissions and taxes. So you need to be able to move in and out of this strategy when it's working and then stop when it's not working. The second thing to point out is, as a fund, we're always raising capital. And so a lot of times you feel, even though we're very patient long-term investors, you feel the pressure to put cash to work. We don't mind holding cash, but there is a pressure to put things to work. Otherwise it's a drag on the portfolio. This allows us to immediately put cash to work. It comes in and we just put it right into the structured dividend capture program. And then as soon as we have a new allocation, we can allocate, to a 10% long-term holding, and we just pull it right out of this. So this is like a use of our cash while it's waiting for a great long-term compounding opportunity. And so it can help people who have high salaries. Anybody who's bringing capital can implement this over the short term until they find their new best, great long-term investment idea.
Yeah, and it's so interesting to see, studying Warren Buffett and Charlie and looking at a lot of value investors. It's a lot of these guys aren't one-trick ponies as well.
Yeah.
They can maneuver in the certain areas that we're in, and so this just does seem like adding something to the tool belt for when the time is appropriate.
Warren Buffett recently bought a bunch of Activision, and I don't know if you caught this, but he said in the annual meeting that he just clarified for everybody. And he said, look, our Activision is basically a workout that we used to do from the 1960s. Microsoft's going to buy it. They offered XYZ price. They have the cash. We think it's probably going to go through, and the shares were selling at a discount. So over a few months, we just make 15% or something. So they just bought billions of dollars in Activision. And that is not a long-term traditional Ben Graham value play. It's like an info arbitrage almost play. It's taking advantage of a corporate event. And so truly these legendary investors, they are pivoting and maneuvering even at large scale through these different strategies. And so although we're a long-term value fund, we are not opposed to just, when there's money laying around, we just go in and grab it. And I think a lot of your viewers are probably sophisticated enough to dabble in this, and the ones that do will find that it's extremely lucrative. It'd be fun to learn what companies people like.
Yeah, and not starting with 15, 20%, just starting at maybe 3 to 5% max.
Right.
And then once you get more comfortable, you start, hey, I can understand this. And I know that's what I'll be doing personally as just trying to take baby steps as this, so that you don't lose, all your money.
And even for the folks that have never dabbled in options, you just upgrade your brokerage account or whatnot, and you get to this sort of situation where you can write contracts. And then you look for a company with a high dividend and you just write one and it expires before the dividend. You're probably going to do okay. You have a lot of things working in your favor. As long as you like the firm and it's a good company, you're going to receive a put premium that's going to give you a margin of safety below the market price. Then you're going to get a dividend. And as you exit with a call, you'll get another premium. It's highly likely that you will make some profit. The first one or two might be a little bit of work, but as you get comfortable, I think most of your viewers can go and try this once and be pretty comfortable that it's going to do okay.
Wow. Well, thank you so much. Yeah, this was amazing. And I do want to be respectful of your time. So I would love for you to tell people where they can find you, learn more about you.
Absolutely. So I run a fund, Peterson Capital Management. Our website is petersonfunds.com. And we literally have 11 years of quarterly letters, annual letters, where I talk about all of this. In fact, some of the diagrams I just showed you are available in our 2021 annual letters, so people can go and look up that information there on our website. We also have a growing YouTube channel. Thanks, Jeremy, for all of your advice on that. And I'm on Twitter, I'm on social media, but I think YouTube and the website are great ways to reach out. And people can always email me, and my emails, I'm not too hard to find.
Perfect. And I will put a link in the description to check out Matthew's YouTube channel as that scales up. So be sure to see the link in the description and his website. But thank you again for coming on and sharing all this valuable wisdom.
Thank you, Jeremy. It's a pleasure to see you again. Pleasure to be here.
If you like that video, check out this video with Guy Spear on how to build wealth right here, and I'll see you there.
Investing is an infinite game. Jeff Bezos, he doesn't walk around saying, look how rich I am. If anything, he says, look at the amazing company that I've built.